Hey Dave, how you doing today?
Not bad, Nick. How are you?
Doing well. Sun is shining. It's Friday afternoon here in beautiful Lansing.
We have
Talking about the markets.
we have broken double-digit temperatures for the day, so I will take it.
Nice.
Yeah. So uh,
Get
kicking
out the
off,
shorts.
right, kicking off the first month of the new year and new quarter by looking back at what the market did in 2021 and kind of talk a little bit more about what's going on right now that's positive and what are the things that are out there to worry about.
Yeah, really, just overall thoughts, generally a pretty amazing market given everything that happened during the year, everything that
Yeah.
happened the last couple of years. Pretty amazing returns and resiliency from the markets.
Right, right. For 2021, the large company stocks in the United States were up 26.5%, which knocking the cover off the ball, no matter how you want to look at it.
Yeah. If we could do that every year, our jobs would be real easy, right?
Right. Yeah. Put your money here, and we'll just sit back and watch it grow. Yeah. Yeah. Small company stocks, pretty good year there too, but not quite as good, but at a positive 14.8%. Um, International stocks, large companies up about 11%. Uh, so the broad markets overwhelmingly positive. The one equity market, stock market that didn't do as well is emerging markets, and it was down about 1.5%. Um, Largely because China controls Chinese stocks make up such a large percent of emerging markets, and there was a lot of volatility and concern going on there. So overall, that's a pretty strong year across the board for the stock market.
Yeah, absolutely. I mean, everything, and also interestingly, with we've talked about it on this podcast before, but large cap growth, large cap value, very consistent, close to one another.
Hmm.
Um, there wasn't really a whole lot of things that didn't do well.
Yeah, yeah, and the the other part of the market that didn't do as well is the bond market. And if we look at bonds across the board, the U.S. broad bond aggregate index was down about 1.5%. But when you consider most of our portfolios are mixes of stocks and bonds, and mostly stock, we'll take a plus 20 some percent and a minus 1.5% on a portion of the portfolio and end up okay, I think.
Yeah, and it's kind of one of those things that like where we always want everything to go up, but honestly, part of the reason why we have bonds and things like that in portfolios is because they kind of work in opposite of what the stock market's
Yeah,
doing. And so
yeah,
having some small losses isn't necessarily concerning when you think about it from the standpoint of if the roles are reversed, hopefully bonds are holding their value and we're
right,
protecting some of the portfolio.
right. And as Michael Kitces always says, if you're diversified, there's always going to be something in your portfolio you hate. And
Yeah.
and as I've had to point out to a few people over the years, we don't own bonds because we think that they're going to outperform stocks. In general, they
Right.
don't. They're there for when the stock market falls apart. And so having them be down a little bit on a year when everything else is so overwhelmingly positive, we'll take that.
Yeah, it sounds strange and kind of counterintuitive, but if you think about it, from that standpoint of good diversification means things are moving opposite of each other and, you know, that's a good thing.
Right, right. So, overwhelmingly good year for the markets. We can take a look and talk about where we're at right now and what's positive and what are reasons for concern. On the positive side, uh, the world is becoming more vaccinated, I guess is a good way to put it. And even with the
Yeah.
omicron variant causing lots of headaches right now for daily life, the rate of death and serious illness is down. So it seems like maybe we're getting a grip on this.
Yeah, and you know, not to speculate too much, but I think part of what's going on with some of the emerging markets, smaller countries, is their vaccination rates are much lower than the developed nation, and so that plays a factor into their ability to open up and kind of what's happening there as well.
Yeah, it does, and so that's had an effect on how emerging markets have gone. And then there's another factor in there. We're going to talk a little bit about interest rates and where things are going, and um, relative currency strength has played into that too. But another positive signal right now is unemployment as of the end of December was down to 3.9%. In most pretty much there aren't enough workers for the jobs out there, and while that is going to trigger some concerns that we're dealing with, it also bodes well for the economy in the long run.
Yeah, it's kind of 3.9% is so low, but it still seems somewhat high given that, every time you drive down the road, you see, signing bonuses to work here. And
Mm-hmm.
obviously there's a, division of what jobs people are looking for and what jobs people are kind of resigning from and getting away
Mm-hmm.
from. But overall, very low unemployment and the labor market is strong from the standpoint of finding jobs because they're out there.
Well, and I remember an econ professor telling me 30 years ago that 3% unemployment was the same as 100% employment for all practical
Right.
purposes, because that meant that you're always going to have a small percentage of workers who are in between jobs, or have resigned one job looking to start another one, that are not unemployed because there's a structural issue with the economy, but just because of what's going on in their personal lives. And if the overall rate is 3%, that means that's pretty much what you're down to, is people that are choosing to be unemployed temporarily, or in between. So we're pretty much there, right?
Right.
So on the other side of the ledger, so on the positive side, we've got the COVID situation seemingly getting better, at least in terms of its economic effects. Equity markets are very strong across the board. The 3-year return on the S&P 500 is 26%, and that's to have 3 years in a row in the 20s like that is just amazing. And then low
Yeah.
unemployment. Then we've got the other side of the ledger, things to worry about and keep an eye on. You know, um, we're pretty much at peak stimulus right now, which means the Fed, the government has done pretty much everything they can do to stimulate the economy, both monetarily and fiscally. And that, like, from here on out, we'd expect that to start to go the other way. um, and stimulus from the government to start to come out of the economy. And we have seen, they've signaled that they're going to ramp up the speed of tapering off that stimulus as we get into 2022. Um, Pretty much the expectation now is for 3 interest rate increases from the Federal Reserve over the course of 2022. And in November, the expectation was only two. So it's they've kind of signaled, the Federal Reserve has kind of pivoted in their talk on inflation and stimulus from saying last summer and fall that most of the inflation we were seeing was transient and because of the pandemic, and would go away as the economy kind of returned to normal. And what they're now saying, they're calling it the Powell pivot, is that some more of that inflation than expected is probably here to stay. And I think you and I last summer, when we were talking about this topic, kind of hinted that our expectation would be like wages aren't going to go down, food prices aren't going to necessarily go down. We may see things like lumber and materials even out, but the fact that some of that inflation will stick around is not too surprising.
Yeah, it's so the Fed's kind of coming out and doing what we expected. No more free lunches. Government's probably not going to send you money to spend. And they're kind of turning and looking at, okay, we've gotten through this event and we've shot all the arrows in our quiver, and so now it's time to go pick up the arrows and reload them, which essentially means raising interest rates so at a future point that they can lower them again if we have another event. But also, their main charge is keeping inflation in check, and so they're doing those things right now to kind of slow things down to hopefully get inflation back in a reasonable rate. And looking at some of the charts that we have, the expectation for inflation isn't, crazy 7, 8, 9,
Right.
10%. It's
Yeah.
2.83. So
Yeah.
it's not like, it's not like inflation is running away, but 2.83 is pretty high compared to where we've been previously
Right.
and what we've experienced.
And that hits it right on the nose. The expectation right now is that it will settle down around 2.8, and the Federal Reserve targets an average of 2%. So being running, just shy of 3% for a while, if that average remains around 2%, isn't such a horrible thing. And we've said more than once talking that we've got to always remember too that inflation is usually a sign of a growing economy and not necessarily a bad thing down the road, as long as it remains near those targets.
Yeah, so definitely not something that we're, looking at of, major impact on things, but certainly something that maybe, continues to be something that we talk about, discuss, and look at, because it's not going away as fast as maybe what we thought it might.
Yeah, yeah, and we're going to have to watch and see what effect that has on interest rates. But what we've seen over the last couple months is the short end of the yield curve, meaning shorter term interest bearing investments, have gone up in yield, and relative to longer term. That's something we want to keep an eye on too, because the curve shape of the yield curve helps kind of give an idea where the economy's headed. But no real causes for concern right now. The yield curve is a normal slope, and um, priced in those expected increases in interest rates from the Federal Reserve.
Yeah, so if you think about kind of our conversation from last quarter to this quarter, very similar in terms of, yes, inflation's around, something to watch, not necessarily concerning, but something to watch. Interest rates probably rising a little bit. And so thinking about practically applying things like, refinancing, securing fixed loans as interest rates go up are all kind of important factors in it when it comes to financial planning. But nothing where we're going, hey, this could cause serious
Yeah,
problems. And as we always talk about on this podcast, whatever that thing is that's going to trigger that market event, we're never going to predict. Nobody, it's going to come out of left field anyways. And so certainly, as our prediction podcast went as well, we're not trying to predict anything. We're just kind of trying to look through and see what happened and explain it and see how that might affect things.
yeah,
But no major bold predictions or changes out of the stuff that we see, because really usually the market will price it in before you and I figure it out, Dave.
right.
And the stuff that we don't know, that's the stuff that you know we A, can't control, so shouldn't be concerned about it, but B, that's what's going to have a major impact potentially on markets. It's stuff that we're not aware of, that it's out there right now.
Right, right. So, what does this all mean? It means stay invested, stick with your plan. Don't obsess about the things we can't control, and see what the short term bears out.
Yeah, absolutely. Kind of a wild couple of years. So if we sat back here at the beginning of the pandemic and talked about where we'd be at today, I think we'd both be pretty very wrong. Um, but here we are. So enjoy that, and stick with it. Things are going to change. Things are going to happen. crazy stuff is going to affect the market. But if you hold on, hopefully you're sitting there 2 or 3 years later going, wow, that really worked out eventually for us anyways.
Yeah.
I think
Yeah.
that's the big lesson, the big takeaway from the last couple of years, at least.
Right, and to keep in mind, like a lot of people are worried about inflation right now because we all are feeling it and seeing it, but we don't. What we have trouble doing is connecting the fact that we've had outsized market returns for the last couple of years, and now, these things don't move in lockstep. But if you think about if you step back and look at like 10 years at a time, inflation's up and your portfolio's up more. So are you better off or are you worse off? And it's hard
Right.
to, we are sitting in January 2022 and seeing, inflation running higher than it has in 20 years. And we need to remember that we just also saw 3 years of, I've got a statistic here, just a second. 2021 would have been like the 18th best year on record for the S&P 500.
Wow.
So,
Incredible.
yeah. And, when you start looking at things in those kind of perspectives and remember, oh yeah, we had things be better than they should have been on one side of the ledger. So if things are worse than expected for a little while on the other, don't get caught up in a month to month view of it. If that makes sense.
Absolutely. It's really about what we talk about all the time, which is concentrating on long-term goals and objectives. Investing isn't about beating the benchmark or figuring out what's going to be the best performing asset class or stock. It's really should be about what are my goals and objectives in the long term, because that's going to ultimately lead to success as
Right.
you maintain your discipline, whether it's a good market or a bad market, and make sure you have the right asset allocation to match your objectives and kind of what your goals are, and sticking with it and taking that long term view. It's not the most appealing investment strategy. It's not something that you're gonna write your buddies about on, or send them a message about it, but it is going to pay the bills at the end of the day, and it's going to get you to where you want to be.
Right.
And so that's really ultimately the goal.
Yeah. Yeah. It doesn't get any Reddit chat rooms fired up, but
No.
it's really the prudent strategy. I just found that statistic I was looking for. 2021 was the out of the 94 years was the 20th best performance of the S&P 500 out of
Okay.
94. But interesting for like broader context on how good things have been market wise for the last several years. 2019 was the 16th best, and 2020 was the 41st best. So,
Wow.
that's to have those group in the top, half, all three consecutively, kind of gives you an idea in of and just keep that in mind when you're thinking about inflation and the fact that gas prices are higher and food is more expensive. So
Yeah.
it's like we already had before.
The good with the bad. We can't have it all. So.
So
But this is good. So obviously, we always like to do these quarterly. So you'll hear back on how 2022 is looking here in a couple months. And as always, if you have questions, feel free to email us at info@srbadvisors.com. Would love to chat with you about investments, diversification, all that fun stuff. Any questions that you have for us or for the podcast, let us know.
thanks, Nick.
Yeah.